reached the end of a pretty long week. I'm Brad, and this is the Noble Precious Metals Report for June 18th, 2021. And today we're digging ourselves out of the debris that is left from the Powell Federal Reserve report from Wednesday. And depending on where you're looking, the bleeding has not stopped really. In fact, the equities markets are looking pretty battered this morning, with all the major domestic indices in the red from yesterday. But the commodities that were so brilliant crimson yesterday are now doing pretty well. We can see a lot of green. There's a little bit of light green, a lot more kind of that sickly mucus green. Don't really know quite what to call it. Maybe forest green. But yeah, so I mean, a lot of where we're seeing the red that was in the energy sector was getting pretty hammered yesterday. The softs were pretty hammered. Metals were, wow, they were just getting beat up terribly. And grains were definitely getting beat up as well. But today we're seeing kind of a reversal on that, at least by a little bit. So they're not where they were before Powell's pontification, but they definitely aren't bleeding out, which is good. And again, as this is kind of left up, you're going to start seeing some changes and some shifts because we're still kind of teetering on that borderline. But before I dig in for today, I wanna wrap with you guys, give a little bit of a straight talk here, and this is something that I see continuously. And it never fails. Whenever silver makes a huge move, either up or down, there are always the inevitable comparisons drawn to some of the runs in the past. It's amazing to me how often someone will trot out the line, well, silver was $50 an ounce back in, insert date here, whether it was the 1980s or 2011 or whenever it happened to be, and then it crashed. Usually this is followed explicitly or implicitly by, and it's going to happen again, and there's hand waving and everything else that goes on along with it. But my other favor is when someone looks at the silver price and sees it dropped and immediately throws out something about manipulation. It's JP Morgan again, or, something like that, or those manipulators. And viewers of this channel are smart enough and informed enough, because you guys are really a great audience, to realize by now that silver and gold today do not move in a vacuum. If there's anything that you could take away from this channel, even if you don't pay attention to the charts or anything like that, it's understanding that when these moves happen, they're not by themselves. That they're not just, silver isn't just dropping by itself. Gold isn't just dropping by itself. Normally it's in tandem with other aspects of the economy, whether it's a general thing or even something that's, broader across a global issue or something like that. So if silver drops that hard, we usually see that larger area of effect. Same as it rises. It tends not to rise alone either. The big difference between this week and an event like, March 1980, when the Hunt brothers' run on silver came to a dramatic crash, is that in 1980, silver moved alone. The only things adjusted in tandem were those vehicles that were related to the run. And part of that, if you don't know the story behind the Hunt brothers and in the 1980 time span, I do recommend looking it up because it is kind of interesting, especially if you're into precious metals at all. But essentially, this took place on the COMEX. They were actually taking physical delivery of a lot of silver, which again is contrary to the behavior of the COMEX. They weren't taking cash in lieu, which now that's not even allowed for precious metals without special exemption. And they were borrowing a lot. They were leveraging so that they could purchase on margin. So essentially, they had tied up about 2/3 of the available inventory on the COMEX, and that drove up the price considerably. So the things that were related to it were basically the silver itself, the assets they were going long on, as well as the equities and the bonds and everything else that were related to the financing that they were obtaining in order to leverage what they were doing. So the banks and the institutions were also exposed as well. Um, so that was a big difference. I mean, we weren't seeing that, like cotton would be up, or other types of things, or lumber would be up, or broad sectors of it, or copper, or and anything like that. So you were seeing a very distinct kind of one commodity, or one issue that was kind of poking up through the din of everything else, and that's not what's happening today. The easiest and most direct explanation of why we're not seeing that today is we're nowhere near a similar economy as the previous. Um, First, at its core, our distribution of consumer goods and manufactured items is more reliant on precious metals than at any time that we could quantify in our history, as well as demand for the finished goods that contain these precious metals is also higher than ever before. I mean, think of the electronics, think of the average amount of precious metals that are in cars, battery technology, solar technology. I mean, it goes on and on. Anything that's technology based is definitely going to have some component that's reliant on precious metals, whether it's gold, silver, platinum, whatever it happens to be. The entire sector is very much tied into our current existence. So that in itself creates a defined foundation for demand and pricing, giving a relatively similar supply level. So if the mines don't produce significantly more, um, I mean, if demand is rising, supply stays relatively steady, then the price goes up. So that's one factor in it. Then, of course, you start adding in something like inflationary aspects, and even that baseline price starts to increase, absent any increase in value or any other factor to it. You're just going to get a raw dollar price that's going to shift upwards. So just by definition, by inflation and demand, we have some certain hard limits that are set on really how low the price can go. So if anyone's expecting to see $3-5 silver again, good luck. It's not going to happen in any grand way that would actually be economically feasible for a long period of time. It would be perhaps a short-term catastrophic crash. But again, if it does, we have larger issues to worry about. So the second reason is never before in our human history has an event disrupted global trade and commerce the way that the past year's pandemic has. These are completely uncharted territories. Drawing a parallel is impossible. So, I mean, anyone that says that they have it figured out, or they're pointing at a chart and saying, "Well, it's just like last time." Well, there is no last time. This is something that's completely brand new, and I would challenge anyone to look back, even over the last, say, 150 years, and come up with a point in time that mirrors the economic conditions that we're in right now, and try to draw some parallels from it. And I mean, I'll be a little bit arrogant here and say you can't. But if you can, I mean, please definitely feel free to try. I'll engage with anyone on that one. So in general, as the warning states, past performance is no guarantee of future results. My personal advice is just to keep learning, get good information from good sources, and keep looking at the big picture. And that's what's important. There's a big reason why I don't spend the entire episode on any of the episodes on just market price charts, because context is critical. If you miss that forest for the trees, you're going to wind up getting lost. So that is my sermon for the morning. Now with that out of the way, let's get into our helicopter as the presidents do and go survey the storm damage from Hurricane Powell that rolled through. Um, so as we can see with the chart itself, the indices are still down. I've been watching them for about an hour as I've been kind of preparing this. And, there hasn't been a significant change. NASDAQ is down today, which is a change from yesterday. The Dow Jones is definitely down 1.27% over yesterday. And yesterday they had a down day as well. So I mean, expect that the typical CNBC and MSNBC and all of those are going to be just screaming about Dow futures are down and 400 points and blah blah blah, whatever else that they blather on about. As you can see, I mean, gold is 1774, silver is 2611. We're doing okay. But as we start getting into this, let's look at the dashboard quick. So this week's reports, today we have nothing. Yesterday we did have, again, the jobless claims, the continued jobless claims, Philadelphia Fed. Everything was right in line with where we were, and I covered that yesterday. As we start looking at the 10-year Treasury rate, we can see that from yesterday, we had that 1.52% close. Today, we're currently 1.51. So we definitely are down from where things are, and we can see kind of the high-low normal. So the low was 1.49, the high was 1.52, and then we're riding right in the middle right now at 1021 at 1.51%. So we're right, treading that middle ground. Things have kind of consolidated a bit, and maybe the panic has subsided just a hair, which would be nice. So going through, let's see, we will look at the market. So silver itself, silver and gold. Let's look at these two together for a second. Very similar patterns, similar to yesterday, and of course throughout the weeks. I mean, we're seeing they're not exact, but they are sympathetic with each other. So when we look at silver, the interesting thing that I did want to point out, which doesn't show up on this so much, but the thing that I've been watching is I do have a 1-minute chart that's open as I look at this stuff in the morning. And on the 1-minute chart, I'm seeing some very wide ranges they're popping in. I mean, I'm seeing like 10% or not 10%, like 10-cent movements within a 1 minute, within a 1-minute range. And what's winding up happening is there's a lot of a battle that's going on right now, right at the resistance level, which is right around that 26. If we start looking at that, I mean, we go from there, and we can kind of see, a little bit from that bottom. We've had some tests that have gotten close, but I mean, these things just keep on rolling along, and so while we're kind of looking at all of this, we just have to keep in mind that this could go either way. This could wind up going either down. It could break that resistance at 26 and go further down, or it could start to recover a bit. And it's going to be interesting to see what way it chooses. But if we start looking at yesterday's VWAP, the previous day, that rolls in not too bad. Again, we still have kind of this trend. It's almost that -3 standard deviation level, which is always interesting. And then today, we're right at about the same price, just a little bit lower. But again, the actual price is still sitting below any of the volume weighted average prices that we look at. So moving in on gold, it's really telling a very similar story. It's it's the Seven Samurai versus Star Wars, that type of thing. Same overall content, just different way of approaching the source material. Um, so looking at this again, gold has largely been uh, pretty well pretty well stable. I mean, it's been on this downward trend. We got to about here, which was the 17th, which was yesterday around 11:25. It seemed like it had kind of bottomed. We had a slight movement upwards, up into the 1790s, and then just like silver, it got slammed back down, and now it's just kind of riding, 1773, 1775, somewhere in that neighborhood. And gold doesn't really have those types of pressures to it. That really seems to be battling. It seems to be just kind of lumbering on the way that it's going. So we do that, and then we look, the gold silver ratio from, noon on the 16th. We look at that. We just zoom in here, and we can see that we were at 16 or 66, 68. We've had a slight rise, 68.17 on retail. We were at 58.51 on the average retail to retail, and now we're at 58.98. So, I mean, about normal. We're still not hitting that 70, which is nice. And part of that is because of the resistance that silver found. But moving on to volume. Volume is interesting to me, and one of the things I wanted to kind of pick out here was, we see the average spikes. We see, gold is kind of looking pretty well normal at this point with the level. I would expect to see this kind of a, April, May, March, April, May type of level of volume. It's relatively anomalous for June. For a second, I forgot what month I was in. But it's something that's, it's not well out of the ordinary. But it's still something that's interesting. But as we start looking at the silver, at the spread, we look at gold, and one of the things that you can probably notice is this whole grouping here that kind of skews down. So we're going from, plus 0.6% down to negative 1.2%, which definitely is that skewing negative. And that was something that really related to the price chart itself. So if we actually look at, say, copper's in kind of the same position as well, just more distributed, more diverse. And again, the volumes really don't get too much above 30,000. And then we drive into silver, and silver has volumes that are, 42, 41.8. But again, it's kind of that same thing. We've got this this one line here that's 0.91% on the positive, but then it goes all the way down to negative 1.27. So we can kind of articulate how the volume is interacting with the actual price changes and what's going on. And it was just kind of interesting to see that type of distribution that was occurring. So moving into retail, the interesting thing here are a couple of points I want to bring up. First, if we look from, say, we'll go to 1400 on the 20th or on the 16th, we can definitely see this downward slide on especially the average item price. But even now, the low price on generic silver is 30.53. So we haven't even broke the 30.5 mark or the 30.50 mark. And the high price is 32.11 with everything riding pretty well in the center, which shouldn't surprise anyone too much. And then I will go over to the American Silver Eagle right here. And the American Silver Eagle, and And again, we had this nice line that was kind of forming up here, not too much change. And then boom, 1400. The high price was 5105. A couple days later, we're at 49.35. So there was a significant loss on the high side of things, and we can even see that translate down below as well. And the lower price, we bottomed out 36.41, and now we're at 36.61. So there was a 20-cent difference, but just an interesting change that occurred. And now for the answer to one of my favorite questions that always seems to get brought up, or one of my favorite topics is, oh my God, the price has changed or it's dropped, but the premiums haven't, or the premiums are going up, or premiums are going to come down, or something else. So what we're seeing is pretty much in line with all of the data. All of this, we're seeing a typical margin, especially on these 1 ounce generics, $5.41, 42 cents, $5.37 back in May 19th. So over the last 30 days. And we haven't seen too much change, although what we have seen is a percentage change. So right now we're sitting at, 19.9% over the commodity cost. And it had spiked up to 20%. But previously it was at 19%-ish. So we're not seeing too much variation there at all. So again, right now, premiums are adjusting, or, that margin is adjusting very, very closely to the way that spot's adjusting as well. And we can see that with, the market to retail charts. There isn't too much that's really varying here. We're dealing with very small variations from the actual spot price to the retail price changes, things like that. So if it was $5, at midnight, it's still roughly around $5 now. That type of thing, and that's better articulated here. We're seeing, the prices are changing. There is some fluctuation that's going on across the spectrum of price or of items. But even that, we're still well under the 1% mark. The generic adjusted by 0.92%. At one point just recently at 8:30. But for the most part, they're running pretty close to things. If I had to venture a guess on average, I would say probably somewhere in the neighborhood of around 0.5%, like 0.5%. So again, that's in the grand scheme of the world, that's really nothing. On to gold. So let's look at what gold's doing. Gold is doing pretty much the same thing. As we zoom in, we get to that 1400 mark. And the reason I'm using that 1400 mark is that's when Powell started speaking, and, the start laying waste to the economy. So we can see that there was that definite dip that came off, and then pretty much it leveled out, which really mirrored a lot of what I was talking about with the spot price itself. So there was a bit of an adjustment, things like that. But we can see that the actual pricing of things, the distribution hasn't really changed that much from high to low, and especially the median and the average have remained pretty tight together, which is good all the way through. So if you're going to buy gold, again, this is probably a discount time for you. We switch down into the gold market, and we start looking at this, and this is even tighter grouping. So the percentage change is almost nothing, except for our perennial favorite of the gold buffalo. The gold buffalo is generally always the outlier. It tends to be much more conservative in its changing of pricing. So if you can get a good deal on it, it's generally pretty decent all the way through. It's not going to have wild fluctuations. It's going to be much more consistent, which is just an observation that I've made casually over it. Personally, I don't really like the gold buffaloes. I don't like the design on them. And of course, we all know that if we're stacking for weight, it's all about the design. Sarcasm here. So moving to the other view, we can see exactly how much change there's been. We've had a slight spike just recently. The Cougarand got up to almost 0.5%. But for the most part, I mean, everything's moving pretty low, probably in the neighborhood of about the 0.2%, which is, again, I mean, on the chart it looks like a lot, but in scale, it's almost nothing. It's, 1/5 of 1%, essentially. So that is really what I have for you. That'll do it for this week and this episode. So if you happen to like what I'm doing, please like, share, and subscribe. Helping me feed the algorithm allows a fact and data-centered report to get out to the larger community. And Lord knows that we could all use that, because the more we know, the better we are. So have a great weekend and happy stacking.